happy 4th of July to everyone, and happy birthday to the greatest country in the world. So happy to be here and be part of this show. And, I'm thinking about all the great things that are in front of us. And at the same time, we're struggling with what's happening in the markets. That we just ended the worst 6 months that we've had in almost several decades, for sure, Derek. And it was not a good first 6 months of the year. And it's probably the worst that you and I have seen since we've been in the business.
Oh, absolutely. It's the worst performance for a 60-40 portfolio going back to the 1970s. And, there really was nowhere to hide other than cash and perhaps oil and commodities. That's essentially it. But we are seeing a few signs of improvement in terms of supply chains, and also the fact that the 10-year has backed up significantly from almost 3.5% to 2.89% in just a couple of weeks.
And that is really a dual-edged sword, because we wanted it to come down and we didn't want to have an inverted yield curve, but it also suggests the certain slowing of the economy. The question is, are we already in a recession, is the conversation most economists are beginning to have. We all know that last quarter we had a negative GDP report, and by most definitions, 2 back-to-back quarters defines a recession. The report that we got at Atlanta Fed the other day, Derek, suggested that we're going to have another negative GDP report. However, we may not be technically in a recession if the board who calls this thing does not say it's a recession.
Oh, that's absolutely right. They look at things like unemployment, job openings, and the rest. And with unemployment below 4%, it's hard to say we're in a recession. That's one of the lowest unemployment readings we've had since I've been in the business. And to my way of thinking, it really doesn't make a whole lot of difference whether we're in a recession or not, because we're investing in stocks, bonds, and alternatives, not the economy.
We're in a recession when your neighbor loses his job, and we're in a depression when you lose yours, is the old supposed to be funny saying. But right now,
can I add a little to that? And we're in an economic boom when my younger daughter has a job.
Exactly. So there's no question right now that unemployment is low. However, things are slowing. We continue to get bad reports from so many economic fronts. And as we go into the second half of the year, we were really trying to be positive because we're headed into an election. Derek, you've done a great job of looking past election year cycles, and that you sometimes get a rally into the election. Do we still stand by that?
That has been the pattern over time. Again, that's an average, and June historically has been the weakest month during a midterm election year, and June certainly was weak this time. And the average decline in the S&P 500 during a midterm election year from the highs is 17%. So while we've overshot that by a little bit, given the magnitude of the news and level of sentiment, it does seem like it's trending that way. And of course, as we get closer and closer to the election, typically September, October, that's when you see markets tend to kind of anticipate the election results, and depending upon the outcome, rally pretty strongly into year end.
And so that's what people have to do, is they have to open up their lenses because of where we've been from the beginning of the year down to June 13th, which was the low. We are technically in a bear market, and it's been a quick pull down or drawdown, as we like to say, in just 161 days. So generally, quick drawdowns mean more shallow pullbacks. And we'll have to see if that's the case here, folks, and how we look going into the second half of the year. But the whole story is going to come down to earnings, which begin in about 2 weeks or so.
Right, and we've gotten a few snippets recently. We saw Nike reported, and they mentioned weakness in China, and the rest, the stock sold off. We heard from Restoration Hardware this week. They also reported slowing. We had a big report from Micron, a major semiconductor manufacturer, on Thursday night, and the key there was their Chinese business on a year-over-year basis was down 30%. Now, we know China was artificially shut down, so I don't believe the Micron earnings were as bad as Wall Street sees it. In fact, the stock was only down 3% after missing, but it led to a complete revaluation of the entire semiconductor space. So again, now we got to focus on those earnings, because as those companies report, perhaps the bad news is already built in. We shall see.